Hi, and welcome to the Homestead Fund's first quarter of 2022 market and funds review. We are labeling this update, "The Heat is On." And you'll hear more about that with our two presenters today. I'm Mark Santero, President and CEO of Homestead Funds, and I'm pleased to be joined by our two senior portfolio managers, Mauricio on the fixed income side and Prabha on the equity side, and they will share with you what's going on in the markets. It's been quite an interesting first quarter to 22, almost epic when it comes to volatility in the markets and what has transpired. We look at what went on in the first quarter. We will also talk about what we see going ahead. So, the agenda, as I just mentioned, we will give macroeconomic conditions and factors for the first quarter. We'll talk then about fund absolute and relative performance. Prabha and Mauricio will speak about the drivers of return for the Homestead funds. And then last, but certainly not least, what is our outlook and fund positioning for the remainder of 22? Appropriately named, "The Heat is On." I'm going to turn it over to Prabha and kick off what happened in Q1 to put things in perspective. Prabha.
Thank you so much, Mark. This quarter was marked, as Mark said, by volatility on a number of fronts: geopolitics, the resurgence of the pandemic in China, and concerns about inflation impacted returns across all asset classes. The fear that the war in the Ukraine becomes a larger war with the West has been a more recent concern. Supply chain issues, which we chatted about in the past, from strong consumer demand, are being further aggravated by the war in Ukraine and shutdowns in regions within China. Energy, grain, critical materials are facing pricing pressure due to supply disruptions from the Ukrainian conflict. On the equity side, we're active managers with a long-term lens. We feel our portfolios are well positioned for favorable returns over the long haul. Now I'll turn it over to Mauricio for the bond market picture.
Thank you, Prabha. The picture on the fixed income side, very similar to the equity challenges that you faced during the quarter, Prabha. Inflation has been and continues to be a sticky issue. The Fed has signaled a more aggressive path towards tightening monetary policy in an effort to bring down inflation, although this is going to take some time. And even the Fed delivered the first post-pandemic rate hike of 25 basis points during the quarter. We still continue to see supply chain challenges. And additionally, the Russia invasion of Ukraine put upward pressure on commodities, driving producer prices even higher. Against this backdrop, we saw Treasury yields trend higher during the quarter. For example, the two-year Treasury went up from 0.73% at the end of 2021 to finish at 2.34% at the end of the first quarter of this year, while the 10-year yield increased from 1.51 to 2.34 during the same period. On a positive note, although inflation remains high, analysts are still quite a bit about the prospect for companies and strong profits during this period. The economy continues to perform well. The unemployment rate has declined from 3.9 to 3.6% during the quarter, and jobs, they remain plentiful, as represented by the latest JOLTS survey. So there are still reasons to remain optimistic out there. Now, turning to performance for the short-term bond fund during the quarter, the fund outperformed the benchmark during the period by 22 basis points. The main driver being our underweight duration position versus benchmark, mainly driven by the front end part of the curve, that be the 2-year and in. On the other hand, corporate spreads experienced some widening during the period, and these detracted from performance in a relative basis, although we did see some recovery during the last 2 weeks of March. In terms of portfolio positioning, We have covered some of our underweight duration as treasury yields rose during the period. We felt that they offer more value, and the proposition of adding treasuries at these levels of, say, 2.5% on the 2-year, it became very attractive in our view. Now, turning to intermediate bond fund, the story is very similar in regard to performance. However, corporate spreads took a little bit more from intermediate bond fund. The fund outperformed only by 2 basis points. Challenging quarter for the aggregate index, nearly a 6% drawdown, something that we haven't experienced at least in the last 40 years, given the inflation situation. The fund benefited from being underweight duration. Additionally, the fund benefited from the underweight in the mortgage-backed security space, which helped offset some of the credit widening that took place in the quarter. From a portfolio standpoint, we remain underweight mortgage-backed securities. We have reduced our corporate exposure somewhat, and we have added to U.S. Treasuries. This is all in anticipation and managing to the volatility that we are experiencing in the markets. And as active managers, we strive to take advantage of these opportunities. Now, turning to the Rural America Fund, the fixed income sleeve delivers similar returns. The main drivers of performance being underweight duration and our positioning in issuers that contribute to the growth of Rural America helped the fund during the period. Now, Prabha, if you could give us some insight into the equity component of the fund.
Thank you, Mauricio. Regarding the equity sleeve for Rural America Fund, we declined about 5%, trailing slightly the Russell 3000 benchmark. The detraction was due to the sector allocation effect. What worked in the quarter? Rural-focused stocks in the industrials and financial sectors performed well. We're confident that rural economic themes such as agriculture and manufacturing and transportation will do well in ensuing quarters. Now we continue with the Homestead Value Fund. We trailed our benchmark, the Russell 1000 value, by about 200 basis points in the period. On valuation metrics, the fund looks cheaper and more profitable than the benchmark. What worked in the quarter? Healthcare, especially the biotech subsector, and industrials, especially government service contractors and aerospace and defense, with all the connected activity we're hearing about. What detracted with the value fund? We were underweight energy, and the sector was particularly strong in the quarter for the reasons we've discussed, and that hurt our performance. Materials also detracted. Here, it was just an idiosyncratic one-off name that was particularly weak, but we have high confidence of the stock outperforming over the long haul. The next fund is the Homestead Small Company Fund. Here we were ahead of the Russell 2000 benchmark in the period by 78 basis points. What worked? Again, industrials helped. Triumph Group was one example, but the defense contractors, Mantech and Khaki, also did well. Financials worked. A few banks were up in the high single digits, and a capital markets holding that benefits from market volatility was strong and contributed to results. What attracted, again, energy was strong, both in large and small cap, and we didn't have exposure to small cap energy. Now back to Mark Santero.
Thank you, Prabha. Thank you, Mauricio. It's always important to look back and see how the funds performed, but as we've said in the past, that is now in the rear view mirror. And what our investors want to know is what's ahead in not only the markets, but what do we perceive to be coming ahead, and how might that affect the portfolio? Before I turn it back to Mauricio and Prabha about what's ahead, I did want to mention what's ahead for the funds in the second quarter. We have two significant birthdays for our funds in the second quarter. Specifically on May 1st, the Rural America Growth and Income Fund celebrates its 1-year anniversary, and we're very excited about the prospects of this fund going forward and the companies and the securities that are invested in rural counties. And also we have a 3-year anniversary for the Intermediate Bond Fund, which is quite a significant accomplishment and one that we're very proud of how it's performed over the past 3 years. So that's what's ahead from the fund standpoint. Now, what's ahead from the market standpoint? I am going to turn it back to Mauricio to give a little bit of what our outlook is for rates going forward. Mauricio.
Thank you, Mark. We like to highlight this chart. We have seen it before. We like to present it again because we like to illustrate here that the Treasury market has already priced in some of the rate hikes that are being driven by the Fed in the near future. So in a way, yes, we have felt a lot of pain, but as I like to say nowadays, with higher yields and higher coupons, we are putting back income into fixed income. So we are coming off very low rates from last year. Now we have more coupon. That carry will help our investors in the future. As a matter of fact, as of today, April 27th, the futures market is pricing in nearly 10 rate increases of 25 basis points between now and the end of February 2023. We are also watching carefully the mortgage market, housing, the effects of higher rates. How is this going to play out? Just looking at bank rate, the 30-year mortgage rate has climbed from 3.27% at the end of 2021 to about 5.42% currently. Although we do think that there will be opportunities in the MBS market in the near future. We remain optimistic on investment-grade corporates. As mentioned, corporations are still strong footing. They were able to refi, to extend debt last year. They have been able to pass cost increases to consumers. That being said, we remain mindful of the volatility, and we will continue to experience this volatility. But as mentioned, we are active managers and we seek to take advantage of this volatility coming up. And now, Prabha, if you could tell us what you see ahead on the equity side.
Thank you, Mauricio. Just to reiterate, on the equity side, we think the U.S. economy is strong, rich in resources. Central bankers have tools. And as Mauricio mentioned, earnings, this has been earnings season, and approximately 80% of the reported results have been ahead of expectations, and we're only partway through the earnings results. Mauricio mentioned housing. This chart shows recession risk with changes in mortgage rates and gasoline prices and the impact on consumer spending. And when the measure is above 10, the yellow line, recessions or slowdowns ensue, not a guarantee, but something to be aware of. But we're not there yet. We're not near that threshold. So over the long term, our portfolios should benefit from the strength of our quality holdings and our active management. And now I turn it back to Mark Center.
Thank you, Prabha, and thank you, Mauricio. One thing that Prabha had mentioned, and I believe Mauricio as well, is we take a long-term view on some of the cyclical trends that happen in the market. We always welcome your feedback. We always welcome your questions, and we certainly always welcome your concerns. My number is right here, listed on this page, as well as my email. Please take any opportunity to give us a call or shoot me an email if you have any questions, concerns, or you want to reevaluate your investment portfolio. Most importantly, we want to thank all our investors for their support and their trust in the Homestead team, and we look forward to serving you in the future. We thank you, and we hope everyone has a very good second quarter and rest of 22.